I'm Melissa Shaw with the Investing News Network at the Sprott Vancouver Natural Resource Symposium 2017. I'm here with Jim Rickards, editor of the financial newsletter Strategic Intelligence. So Rickards is a lawyer, economist, investment banker, and New York Times bestselling author. His latest book is The Road to Ruin. What are some of the key points you discuss in the book?
The key points I discuss in the book, it's a couple of things. First of all, my models and my way of analyzing global capital markets and risk in global capital markets using several branches of science which have not been applied by Wall Street. So Wall Street, sell-side research, central banks for that matter, finance ministries are using variations of what they call dynamic stochastic general equilibrium models, regressions, correlations, and a lot of tools that are, first of all, obsolete, and secondly, are not good reflections of how markets actually work. Markets operate in much more in accordance with a branch of science called complexity theory. So I use complexity theory, network science, behavioral psychology, actually use history, a great teacher, and a branch of applied mathematics called Bayesian statistics. Bayes' rule or Bayes' theorem, it goes by different names. We're combining all these to forecast markets. So I talk about that, a little bit my personal adventure, how I got there, my work with the intelligence community, my work with centers of excellence such as the Los Alamos National Laboratory. I also talk about my personal experiences in a couple meltdowns. 1998, that was the emerging markets long-term capital management Russia crisis, but I was the chief lawyer, general counsel of long-term capital management. So I not only lived through that, but I negotiated that bailout. So that was a front row seat on how markets can collapse. And out of that experience, I then pursued really a kind of personal odyssey, 10 years of working in all these scientific areas to learn more about how risk actually works. One thing I knew after LTCM was risk doesn't work the way everyone thought it did. We had the smartest people in the world. I mean, we had 2 Nobel Prize winners, 16 PhDs, great people, nice people, but with IQs of 160 and up, so no shortage of brain power. But that ended disastrously. And the reason was not because we didn't have smart people working in good faith, but because they had the wrong models. And so I set out to not only prove that, find out what was wrong with those models, but also to come up with models that do work. And so this is actually all connected to a new company I've started and some other research I'm doing. But the point being is a blend of economic history, so I take the reader through a couple of these crises, personal experience, and science and history. So hopefully it's very interesting for the reader.
So what kind of changes have we seen in the U.S. under President Donald Trump in terms of fiscal policy and trade? In particular, what's been in the news a lot recently is the Section 232 review regarding the U.S. steel industry.
Right. So I think we need to separate what Trump did and said on the campaign trail and some of his early statements from what has actually happened. And that's a very big deal. Because if you go back to election night, November 8th, and into the morning of November 9th, after some initial jitters and the kind of the shock of Trump's election wore off, the stock market just took off and rallied very significantly in November, December, January, flattened out a little bit in February, March, but has rallied again strongly this spring and summer in May, June, and July. Major indices up over 20%, about 20% since President Trump was elected. Now, what was the basis for that? It was based on him saying we're going to have tax cuts, we're going to have infrastructure spending, we're going to repeal Obamacare, reduce regulation, etc. And that was viewed very positively by the markets. In fact, none of this has happened. Lots of noise, lots of storm and stress, lots of votes, lots of the days on the legislative calendar used up, but they haven't repealed Obamacare, they haven't enacted tax cuts, they haven't put forward an infrastructure spending bill. So to some extent, the market looks like it's floating on thin air. I mean, I understand the earnings have been good. I don't put much stock in earnings beating expectations because the expectations are managed down, and so that's a kind of a fool's game. The year-over-year earnings look strong, but 2016 was a weak base year, so I think there's a lot less there than meets the eye in terms of why stock markets are so strong. Meanwhile, I see a lot of storm clouds, the Fed raising rates into weakness. I think the U.S. economy is fundamentally weak. I think. Again, there's a lot of data to support that up. Strong trends in disinflation, auto sales down, retail sales down, disinflation, as I say, coming on very strong. All this, I think, will cause the Fed to flip back to easing mode later in the year. Very, very bullish for gold, among other things. But specifically, Melissa, on your point about the tariffs, there's a trade war. It's coming. It's starting right about now, literally as we speak. The president has a trade troika, as I call them, This is Robert Lighthizer, U.S. Trade Representative, Wilbur Ross, Secretary of Commerce, and Peter Navarro, Special Counselor, head of the White House Trade Council. They're all hawks. They all believe in tariffs. They all believe that China is dumping steel and aluminum, not just China, but other countries around the world. They're ready to impose tariffs. They've been holding off so far because the president was trying to get Chinese help with the North Korean situation, and that took some months to resolve. It's now clear that China is not able to help or is not willing to help. Either way, it doesn't matter. China's not going to help us with North Korea. So the president is kind of unleashing his troika. You're going to see some very strong trade sanctions. And to the point you mentioned, they're not just going to use standard anti-dumping tools. They're going to use national security as a lever. And that's very important because it not only increases the number of tools in the toolkit, but in some ways makes it immune from challenge in the World Trade Organization, WTO review, because WTO has exceptions for national security. So if you use national security, you can get out from under WTO review to some extent. So a trade war is coming. It's literally starting in real time now. The timing is the result of China's failure to help with North Korea.
Is that just something that will affect steel imports, or is that something that's kind of more protectionist in other ways?
I think it's protectionist in other ways. Obviously, kind of bullish for U.S. steel companies. So, United States Steel, U.S. Steel, Nucor, and some others should get a lift from this. That's pretty clear. It'll hurt Chinese steel companies. But I don't expect the Chinese to take this lying down. I certainly don't expect the Chinese to end their subsidies as a result of our tariffs, because there's a global market. They can still sell steel to anyone else in the world, Mexico, Latin America, Africa, Europe, anyone else who might need it. This is a global problem, and it is a global market. But I would expect China to retaliate. By the way, in addition to the steel and aluminum sanctions, or tariffs really, which we mentioned, there will be financial sanctions imposed on Chinese banks that are helping North Korea to pay for imports to conduct its missile and nuclear weapons program. So, point being, there's a connection between North Korea national security, financial warfare, trade sanctions. None of these things stand in isolation. So I would look for the U.S. to hit China with tariffs on steel and aluminum, but also financial sanctions on banks that are helping North Korea. I would look for China to hit back, not take it lying down, but impose limits on direct foreign investment in China, the ability of our financial institutions to expand in China, a lot of other ways, and, theft of intellectual property, cyber warfare. There are many ways this could escalate. So I think it is much, much broader and more dangerous and potentially more detrimental than just tariffs on steel.
You touched on the Fed tightening rate cycle a little bit. So there's a meeting this week with the Fed as well, but they're not expected widely to raise rates. The rate increase, most people have said, is coming next year. And then at the same time, we've had the Bank of Canada, who just recently raised the rates as well. So can you just maybe touch on that? And you mentioned the U.S. economy potentially being a little bit weaker than perhaps it could withstand with these rate hikes.
Right. So the Fed's been in tightening mode since May 2013. That's when Ben Bernanke gave the taper talk speech. And what he said at the time, he didn't actually do anything. He didn't raise, it was far from raising rates and did not actually start the taper. But he said, I'm thinking about starting the taper. That alone, was enough to start an emerging markets meltdown. I mean, capital flew, left hot money, capital outflows came from emerging markets. Those markets went down, et cetera. Then there was just a whole sequence of events. They started the taper in December 2013, finished the taper in November 2014, removed forward guidance in March 2015, raised rates for the first time in December 2015, and a couple more rate hikes December 2016, March and June 2017. So that's the sequence. So a lot of people think the liftoff started in December 2015 with the first rate hike, but really accelerated in December 2016 with the sequence of three that we've just seen. But I would make the point that, no, the tightening goes all the way back to May 2013. Now, the reason that's important is because, as we know, monetary policy acts with a lag. It takes a year to 2 years for these steps to actually flow through to the real economy. Now, the initial steps were mostly in the form of talk. I realize that, and the actual tightening didn't begin until December 2014 with the beginning of, 2013 rather, with the beginning of the taper, and then accelerated from there. But you come 2 years forward, it's no surprise that here we are, looking at data late 2016, early 2017. We'll have second quarter 2017 GDP data coming out in a few days. We'll be able to look at the entire first half. It looks like U.S. growth is even weaker than the lousy growth we've had since the expansion began in December 2009. None of this should be a surprise because, as I say, the tightening started a long time ago. Now, you're right, the Fed will not tighten rates at this meeting, this July meeting, July 26th and 27th. But they might say something about inflation, which would indicate that they're not in any hurry to raise them anytime soon. And they might talk about balance sheet normalization, which is a separate form of tightening independent of rate hikes. This has to do with not rolling over maturing positions in U.S. Treasuries, and at the margin that should increase intermediate term rates a little bit. So my forecast is no rate hike in September for the reasons we just discussed, which is the U.S. economy is slowing down. The problem is, once again, the Fed has blundered. What we're seeing now is the impact of some things that happened in 2014, 2015, early 2016 with a 2-year lag. Well, they kept tightening. In 2017, that has yet to play out. So that's going to be even more of a headwind for the U.S. economy.
So in light of all of these things that we've just talked about, what advice do you have for investors?
It's a very dangerous time. I think we will see more of what we've seen for the last 4 years, which I call the Fed flip-flop. In other words, there's no question the Fed wants to tighten. They want to tighten. Whether they can or not, given the real economy, is a separate issue. Now, why do they want to tighten? If the economy is weak, or it even looks like it might be weak, why on earth would you tighten? The Fed never does that. The Fed hasn't done that since 1937. Typically, they tighten into a very strong economy that's running a little hot in terms of inflation, low unemployment, et cetera. Here they are tightening into weakness. The reason is they didn't tighten when they should have, meaning 2010, 2011, 2012, early in the recovery. That was the time to tighten. That's when the Fed normally would have retightened in a normal business cycle, which this isn't, by the way. This is more of a depression that we're living through right now since 2007. So the point being, the Fed didn't tighten when they should have. They're desperate to raise rates now, not because they think that's good for the economy, but because they're getting ready for the next recession. Research shows that it takes about 300 basis points of rate cuts to get the U.S. economy out of a recession. If we went into a recession tomorrow or even next year, how could you cut rates 300 basis points if they're only 100 basis points? The answer is you can't. You've got to raise them so you can cut them. And that's what the Fed is doing. They're trying to raise them now so they can cut them later. The danger is, by raising them now, will they cause the recession that they're actually preparing to cure? And the answer is they might, and that may be playing out kind of in front of our eyes. So when they see this disinflation and this weakness that we talked about, they'll flip back to easing. How do they ease? Well, they're not going to cut rates at this point. They're pretty far from that, but they can ease through forward guidance. They can say, hey, just kidding. We're not going to raise in September. We're not going to raise in December. We don't know when we're going to raise. It could be a long time. That's forward guidance. That would be a form of easing through words. That's very bullish for gold. Could actually give stocks a lift, even though in my view the market's overvalued and in bubble territory. One thing we know about bubbles is they can get bigger before they crash. So it's this risk on, risk off, easing on, easing off, flip-flop that's gone on 8 or 9 times since 2013. We could see that again. My advice for investors is increase your cash allocation just because of the uncertainty. It doesn't mean you're out of the market forever, but it means that when we get a little more visibility, either whether the economy's in a recession, which it might be, or the Fed flips back to ease, you can pivot. The person with cash is the person who, A, is not suffering losses, and B, can get into asset classes once we have more visibility. I recommend about 10% gold. I think gold is going to have a very strong second half of 2017 for the reason I mentioned, which is, ironically, a weak U.S. economy, disinflation, which is normally bad for gold, could be good for gold if it forces the Fed to flip back to ease, which I do expect. And I would cut my stock exposure because equities look like a bubble to me. I'm also very bullish on the euro because ease by the Fed will weaken the dollar. That will strengthen the euro. So I think the euro is a good play as well.
Do you have a forecast for the gold price?
I'm not a technician. I look at charts and I look at inflection points. So I do use charts, but I don't consider myself a technician in the formal sense of the word. But I'm actually impressed with how strong gold has been given the headwinds. Given everything we just discussed about the Fed tightening and the strong dollar, until recently, the dollar is getting weaker right now, but the dollar was on a very strong trend in 2014, 2015. Given those headwinds, I'm surprised gold's not lower. It's been kind of hanging in there. I think that's attributable to physical supply and demand. The price of gold it's not set like a normal commodity based on normal physical supply and demand. it is easily manipulated by large sales of paper gold in the COMEX futures market. So gold's had headwinds, it's had flash crashes, it's had manipulation style selling of, those one sales equivalent of about 60 tons of gold sold in paper form. There was no actual gold involved. Took the price down very steeply. This happened in a couple times in June and early July. Try finding 60 tons of physical gold. You can't do it. If I sold you 60 tons of gold and you called me up and said, hey, Jim, deliver the gold, you couldn't do it. I mean, no amount of money could scrounge up 60 tons of gold on short notice. There's just not that much in the world. I know that because I talk to refiners, I talk to miners, I talk to gold dealers, I visit vaults, I talk to the people who handle the physical gold. You couldn't, I don't even know how long it would take to get your hands on that much gold. But if I sell paper gold in the futures market, it's child's play to take down the market. So my point being, the fact that gold has done well with that many headwinds tells me that as and when the headwinds are removed, which I do expect, as the Fed flips to ease later this year, which I do expect, gold should get a very strong lift. Based on that, I would expect it to have a strong second half, go past $1,300 an ounce in the next couple months. Once it does that, that will have an important knock-on psychological effect, and you could see a very strong gold rally back up to the levels just prior to Trump's election, which were in the kind of 1320 range. So I look for a strong rally to 1300, maybe beyond that, as high as 1320 by the end of the year.
So while we're on the subject of forecasting, you have a new project that you're working on. Can you talk a little bit about that?
It's a company I formed a year ago with some partners who put together a great team. The company is called Miraglim, Meraglim. We have a website, miraglim.com, so there's a lot of information for people who are interested there. But what we're doing basically is taking the kind of forecasting analytics that we've been talking about in this interview, putting them into models, and then working with a team of cognitive scientists and developers and creative designers at IBM with the Watson capability behind us. Watson is a computer system that can, apart from high-speed processing and supercomputer capability, it can also read and speak languages. I think it speaks about 7 languages. It can talk to you. People may have seen it on commercials. So we've got top cognitive scientists from IBM, a team that includes top PhD applied mathematicians, seasoned market individuals, a couple of us with intelligence backgrounds. These are things that I learned at CIA and my partners learned in Army intelligence about how to solve problems with insufficient data, and putting out a predictive analytic platform. Again, a lot available on our website, but we're very far along in the development. I was on a team call this morning, very, very enthusiastic and excited about this.
Great. Thank you so much.
Thank you, Melissa.
I'm Melissa Shaw, reporting for the Investing News Network at the Sprott Vancouver Natural Resource Symposium 2017, and I'm speaking with Jim Rickards, author, lawyer, economist, and investment banker.